So welcome everyone. Thank you for joining our wonderful session. And thank you to Jenny Dooling for agreeing to donate her time and expertise to us. She's a graduate of our LLM in taxation program, and we're very proud to have a great alum like her out in the world representing us and representing the good that tax can do in the world and in your lives. So I will hand it over to Jenny to introduce herself a little more, talk about her area of expertise. Thank you so much for joining us.
Yeah, thank you for having me. And feel free to ask questions. I don't mind, if this being an interactive session. I'm Jenny Doling. I am a bankruptcy and tax attorney. I have been in practice for 25 years this year. I am a California State Bar certified bankruptcy specialist. My entire practice is just bankruptcy and tax. What got me interested in the LLM program at USD was I was discharging taxes for clients in bankruptcy, and not all taxes are dischargeable in bankruptcy. So I was working on offers in compromise, installment agreements, things like that after the bankruptcy for the portion that was not dischargeable in a bankruptcy. And I got good at it, and I kept getting referred bigger and bigger cases. And at the same time, I was referred two totally separate cases, two physicians. They each owed over $1 million and had some more complex issues. And I did not feel I had a strong enough background in tax to handle those cases. And I am more one of the ones that doesn't play fast and loose. So I referred those out. And it got me to thinking, that is a retainer walking out of my office, and there is no reason for that. And so I kind of started exploring an LLM program, and it got a little more on my radar, and I started getting information from USD and a couple different programs. And one day I came into our home office, and my husband was sitting there, and I said, "Hey, I need to talk to you." And he said, "Why are you being so serious? What's going on?" And I said, "I think I want to go back to law school." He's like, "Okay, well, what is this? What do we need to do? Let's do it." And so I was telling him why, and he said, "Okay, well, what does that look like? What do we have to do?" And I said, I was very interested in USD's program. I think it's the one that fit the best for us. It's known nation and worldwide, and has such a great program. And I think at the time we were talking about doing it in person. I know they've got an online program now, but I definitely was excited about the in-person program, but I was still running a full-time law firm. So I was a little nervous about that as well. And how do I incorporate this? And this never would have been something that I could have considered prior to COVID and prior to Zoom, knowing that I had streamlined my law practice on Zoom already gave me the confidence of going ahead and going back to law school full-time and still running a full-time law practice. So that's kind of my story. I had a great experience at USD in the LLM program, really boosted my confidence and my knowledge. And after that, I've been off and running. I am completely slammed. We know with what's going on with the IRS and the layoffs and things like that. Consumer bankruptcy is also has gone up significantly, 72% nationwide. The filings are up. My practice, January of 2024, I stopped taking any litigation cases. So I finished my last two trials last month. And I've stopped taking the subchapter 5, which is chapter 11, subchapter 5, plans of reorganization in my practice. So now I'm bringing on more tax controversy work. I enjoy the work, and still running my consumer bankruptcy practice. So that's kind of a background of where I'm at, how long I've been in this, and what brought me to the LLM program. I was going to kind of talk about discharging taxes in bankruptcy today. A lot of people don't realize that taxes can be discharged in bankruptcy. So it's kind of shocking to lawyers when I give these presentations. They think you owe tax debt, you're saddled with it forever unless you do an offer and compromise. And that's not the case. And there is a general three-pronged test that we use to determine whether or not taxes are dischargeable in bankruptcy. And you do need to have a good understanding of bankruptcy law. And you also have to understand that there are nuances among the circuits. So the Ninth Circuit does some things a little differently than the First Circuit or the 11th Circuit. So those are some things to watch out for. I practice in the Ninth Circuit with regard to bankruptcy. I take tax controversy matters nationwide, but as far as bankruptcy goes, I'm just in the Ninth Circuit. Most of my cases are filed throughout California, primarily in the central and the southern districts of California. The Central District of California is the largest federal district in the entire country. So we have the highest number of bankruptcy filings in the country. There's a lot of work here, that's for sure. And the tax work is skyrocketing as well. Bankruptcy and tax go hand in hand. Both of them use what we refer to as the IRS allowables. Those are the numbers that the IRS says, here's the income for your family size in your area. Here are the expenses the IRS will allow you to take a look at for an offer and compromise or in bankruptcy. So those are crossover things that are helpful and make these two areas of practice very complementary. So let's kind of kick it off with some general rules for bankruptcy. Priority tax claims are not dischargeable in bankruptcy. A priority tax claim means that the tax is basically too new to be discharged. So that would make it fail the three-pronged test that I was referring to right off the get-go. So what we look at is the tax had to have been due at least 3 years ago. So if we're looking at 2022 taxes, we know that the filing deadline for 2022 doesn't come until April of 2023. So we start calculating that 3-year test in 2023. So we know those taxes are not going to be able to be dischargeable until 2026. If the taxpayer filed an extension to October, then we also have to wait until October to file the bankruptcy. You file too soon, you can blow the dischargeability of your client's tax. And guess whose pocket they're coming to for that? That's going to be a malpractice claim. So we want to make sure we avoid any kind of malpractice issues. Also, unfiled returns cannot be discharged. You had to have at least filed your tax return 2 years prior to the bankruptcy. So you could have been late in filing, but it has to have been at least 2 years since that tax return was filed. And the IRS could not have filed a tax return for you. That's called a substitute for return when the IRS does that. And we refer to that as an SFR. If we see an SFR on your tax transcript, we know that that tax year is dead in the water. It's not going to be dischargeable in a bankruptcy. Some jurisdictions, some circuits don't allow if you filed even a 1-day late tax return. So you got to watch out for that and make sure that you're following your circuit to make sure that you're complying with 11th Circuit, First Circuit. But in the Ninth Circuit, we don't care if you're late. You can be late. That's not a big deal. Fraudulent returns or a willful attempt to evade taxes, those years are also not going to be eligible for discharge. So you'll need to figure out a different way. But again, bankruptcy can be used as a blended tool where you get discharged as much debt as you possibly can. And then after the bankruptcy, all the cards are on the table. The IRS sees the assets that you have, the income that you have, your expenses, and you can put together an offer and compromise fairly easy after a bankruptcy. So going through the 3-year rule, the practice tip, we always look at the actual return filing date is completely irrelevant. What we're looking at for the 3-year rule is when was that tax return due? We have to be careful on this because the federal government has also taken to extending filing deadlines. So they may have extended a filing deadline for weather, like they did in Texas when they had the huge blizzard that, knocked out the power, or in California for the fires. There's been hurricane extensions. So we need to watch out for things like that. The IRS has said it is not going to apply that federal extension for determining dischargeability, but that's not the statute, that's not the rule, we don't have that in writing, so that makes me a little nervous. I would rather wait and use whatever the due date was and go by that just to be on the safe side. So practice tip, always pull your client's tax transcripts. And there's about 6 different ones. I go back 10 years on pulling my clients' tax transcripts. And the ones that I like to get are the account transcripts. Those give me the codes that I need to determine how the IRS is treating a filing. There's 150 codes, there's 420 codes, there's 520 codes, there's all kinds of codes, and the IRS discloses those. If you look at irs.gov, you can pull up cheat sheets where it will give you the explanation of those codes. But the tax transcripts are really, I would never file a bankruptcy without getting the tax transcripts if I knew my client owed. I think that right off the bat is malpractice. Clients can tell you all the times, I file my returns on time every year, and you pull their tax transcripts and there's a return missing that didn't get filed. Maybe it got electronically rejected and their tax preparer never told them. Things like that we see all the time. So just getting the extra assurance that the tax transcripts represent the history for the client. And those can have mistakes too. So you'll want to refer those with your clients, review those with your clients to make sure that there are not any mistakes in those tax transcripts that need to be addressed before you take on a bankruptcy. Another funky thing about the IRS extension dates, a lot of people don't know that the IRS, and I was going to pull up my little cheat sheet here, the IRS has DC extensions. So when there's the Emancipation Day for DC, that's a federal holiday for DC, that makes that an extension deadline for all of us, not just DC. So that can extend the filing deadline from April 15th out to sometimes April 19th. And if you pull the trigger on filing your client's bankruptcy on April 15th, when the due date was actually April 19th, you could again blow the date. So you don't want to play fast and loose with that issue. So 3-prong test. First prong is you have to have had at least 3 years since the tax return became due. The second rule is it has to have been at least 2 years since the tax return has been filed. And then the third prong is it has to have been at least 240 days since the IRS assessed the tax debt. Assessment basically means here's the notice, here's what you owe on this. The IRS can still have an opportunity to do multiple assessments. So you want to make sure the final assessment has been entered on the client's tax transcript so that you have met the 3-prong test. Now, there could be tolling events, and this is where it gets sketchy. Just as a side note, I do tax analysis for fellow bankruptcy attorneys nationwide, because they're charging, $2,500 to, $4,000 to do a simple Chapter 7. And if you've got a client that owes, $50,000, $100,000, $1 million in tax debt, they don't want to screw that up, and they're only charging this much. So it's not really a cost benefit for them to give the tax advice. So they'll refer me those cases and I'll do the tax analysis. I engage directly with the client. I order their tax transcripts and make my recommendations with regard to when it's safe to file a bankruptcy. And again, my fees on just the tax analysis part, the minimum is $2,500 and it goes up depending on how many years my client owes, how much money that they owe. So the biggest one I've done recently was a $7,500 tax analysis. Probably took me about a month to go through all the tolling events and everything. I want to make sure I go through it manually. I run it through some software. I go back through it manually. I set it aside, make sure I've crossed all my T's, dotted my I's before I send that final product. And my tax analysis letter in that case was 11 pages long. The tax transcripts, we had to actually give them access to a portal because there were too many and they were too lengthy to send even in a zip file. Tolling events. What could be a tolling event? If the client extended the tax filing through an extension, that can be considered a tolling event. If the client submitted an offer in compromise, while that offer in compromise was pending, that tolls the statute of limitations. While a bankruptcy is pending, that tolls the statute of limitations. And it's not just tolled for the time period that was pending. In bankruptcy, there's different categories where they add on plus an additional 30 days or plus an additional 90 days. And you have to be aware of the bankruptcy codes that affect those tolling events. On the IRS tax transcript, a bankruptcy code is usually logged as a 520 code. And it's not always a bankruptcy. Sometimes the IRS accidentally uses the 520 code to represent that an offer in compromise was submitted. So sometimes I see, oh, we've got a 520 code and the client never disclosed a bankruptcy to me. So I do a PACER search. PACER is the government system where you can look up federal cases. And so I look up and nope, they're not in the bankruptcy system. So I'll go back to the client and say, are you sure you did not file bankruptcy? And they'll confirm. So then we'll call the IRS and just confirm, oh no, that should have been the OIC code, the offer in compromise code. So you just taking those couple extra steps to make sure you don't blow it is very important. We have come across a couple cases where there were fraudulent bankruptcies filed where the clients never knew there was a bankruptcy filed. That can be done if somebody was trying to stop a foreclosure. We saw that a lot during the 2008-2014 real estate crash. People were going to do loan modifications. And part of the loan modification scams that were being done is that they were filing bankruptcies for these clients and the clients were not aware. And they were just doing it to get the protection of the bankruptcy automatic stay. An automatic stay does not require notice. It goes into effect immediately upon the bankruptcy's filing. That's why they call it automatic. Eventually the creditor will get notice, but the whole point of that is to stop everything, give everybody a level playing field in the bankruptcy process. When creditors are clamoring to get assets and things like that, you just need a reprieve. You need to stop everything, give the bankruptcy court, the bankruptcy trustee the opportunity to evaluate what are the assets, what's the plan of reorganization, what's going on here. So the automatic stay is very powerful. Yes, it can stop the IRS. Any actions taken in violation of the automatic stay are void, not voidable. I don't have to do anything to go ask the court to reverse something. It's void as if it never happened. That's not to say that there's never disputes. There can be disputes, and you go in and you ask the court to settle those disputes. But for the most part, everybody knows what the automatic stay means and generally plays by the rules on the automatic stay. Any questions so far? I want to make sure I'm not going too fast here. Okay. Let me get I just put Zoom in the way of my outline here. Okay, so doing the tolling events, under 507 of the bankruptcy code, there are tolling events. So if a taxpayer files an offer in compromise and the 240-day assessment period for the IRS to assess additional taxes is extended by that offer during the time it was pending, plus an additional 30 days. If there was a stay against collection from a prior bankruptcy case, that 240 days is that 240-day assessment period for the bankruptcy purposes is extended for the time it was pending in bankruptcy, plus an additional 90 days after that bankruptcy case is either discharged or dismissed. So you've got to look for the beginning dates of these tolling events, the date the bankruptcy was filed, and the ending date, what concluded that case. Doesn't necessarily mean the date that the bankruptcy case was closed. Closed and discharged in bankruptcy are two different things. A bankruptcy case could remain open for months, even years after the discharge is entered, if the bankruptcy trustee is still administering assets, selling off assets, doing distributions to creditors, things like that. So those two dates are completely different. The time period is also suspended for any period during which the IRS is prohibited from collecting a tax. If the IRS is prohibited from collecting a tax, then there's going to be that additional 90 days added. We pay attention to the flush language as part of the bankruptcy code. 50788 of the bankruptcy code deals with those tolling events and the additional time that's added on to those. An example would be the IRS issues a CP 504 notice. That's the notice of intent to levy and the taxpayer's right to request a hearing. In response, if your taxpayer files Form 12153, which is the request for collection due process or equivalency hearing with the IRS, that is an administrative hearing that lets the taxpayer offer a collection alternative prior to an administrative levy, such as an offer in compromise or an installment agreement. And during that time, that 240-day assessment period is suspended. So that's a good example of what would suspend that 240-day period. Again, practice tip, do not file a bankruptcy without confirming the dates of the limitations period for the assessment. You want to make sure that those have expired. So we've got the 3-year, the 2-year, and the 240-day rule. The exceptions to the general rule: false returns, 26 USC 6501 C1. Willful attempt to evade tax would be 26 USC 6501 C2. No return filed would be 26 USC 6501 C3. And an extension by agreement would be 6501 C4. Those are all important code sections to remember when you're trying to figure out whether or not a tax might be dischargeable in bankruptcy. Other taxes also follow that 3-pronged test, but they have their own statutory nuances you want to make sure that you check into. Payroll taxes are dischargeable in bankruptcy. However, the trust fund portion of the payroll taxes is never dischargeable in bankruptcy. The trust fund portion is the portion that the employer withholds from the employee's check. The matching portion that the employer is supposed to match is the portion that would be dischargeable in bankruptcy if it met all of the qualifications. Sales tax can also be discharged in bankruptcy. State income tax can also be discharged in bankruptcy. Generally in California, the Franchise Tax Board follows the IRS. So if the IRS deems the tax dischargeable, so will the Franchise Tax Board, unless the debtor did not file their tax returns with the Franchise Tax Board. Generally, most people file both, but you occasionally run across somebody who may have only filed their IRS returns and not their state tax returns. One of the things I tell clients all the time is file, file, file. I don't care if you don't have the money to pay, always file your tax returns, file them on time. That at least starts the statute of limitations running and gives you more options in the future. Other things that we deal with in bankruptcy on a regular basis are tax liens. Tax liens cannot be stripped off in bankruptcy. I don't know if you've heard that term, or avoided in bankruptcy like a judgment can. But they can be reduced in bankruptcy, and you can get the IRS to release those tax liens. In bankruptcy, we have exemptions. Exemptions are the laws that protect our assets. So you may have heard of a homestead exemption. We have a vehicle exemption, things like that. Exemptions do not apply to the IRS. So you may think that your client's house is fully protected and there's nothing the IRS can do because your client has this great California homestead exemption that has just been increased. That the maximum in California, we're sitting at around $722,000 in equity. And the IRS says, yeah, hold my drink. That doesn't apply to us. So we want to make sure that if the client has equity in the property, that they're not putting the property in jeopardy by filing bankruptcy. In the Ninth Circuit, we have the Warfield case. And there's some funky things that happen in bankruptcy. A bankruptcy trustee can stand in the shoes of the IRS. And in some states, because their circuits don't have a similar law like California does, or the Ninth Circuit, I should say, not California, that allows them to stand in the shoes of the IRS and sell the debtor's homestead, their home, out from underneath them because the homestead does not apply to the IRS. In California, we have In re Warfield, which is a Ninth Circuit case. It's very recent, a couple years old, that the IRS fought. The IRS said, no, we don't want to be selling people's houses. That's for more egregious cases. We don't want that. But the bankruptcy trustee said, hey, we can do this. And the IRS is the actual party that fought them on that. And they said, we don't want you to sell it on our behalf. So in that case, the Ninth Circuit ruled that no, that property was exempt and it left the bankruptcy estate. So it was no longer there for the bankruptcy trustee to administer. And so there was no longer, you couldn't stand in the shoes of the IRS to do anything with that asset. That is not the same in all circuits. So again, you got to be careful what circuit you're filing in, what the applicable law is for your client's case, but it's really important. But so for example, I have a client, they don't own a home, but they had a $300,000 401k. Again, normally that would be exempt in bankruptcy from all creditors, but it's not exempt from the IRS. They had an old vehicle, things like that. So when we calculated everything that they had asset-wise, they had about $400,000 worth of assets. None of them really worth liquidating to pay the IRS. The IRS, sure, will take the 401k, but how does that help society? It's about policy and looking at, does that help us not having somebody retire in a few years when we've completely wiped out their 401k? So in the bankruptcy, we were able to get rid of all of the debtors' consumer debt, which was about $75,000. But the IRS debt was still about $150,000. That was $150,000 after we were able to discharge some of it in the bankruptcy. We went to the IRS and we said, all the assets here, excluding the 401k, total about $89,000. And none of them alone is really worth liquidating. Will you release the lien if our client pays 10 grand towards these assets? And, after a few months, the IRS said, yeah, that's fine. We'll agree to that. So the client withdrew $10,000 from their 401k, and they did it through a 401k loan, actually, so they didn't take a hit. We paid that $10,000 to the IRS, and the IRS released the lien. And that was a great result. The client came out of that, was able to keep their 401k, did not lose their assets, and paid 10 grand. And the IRS was satisfied with the bankruptcy schedules that we had provided, the bankruptcy trustee. Think of bankruptcy as the guardrails. You have to pass a means test if your debt is primarily consumer debt. You have to pass the means test to pass go and get a discharge in a Chapter 7. You have to disclose all of your assets, any rights you may have, a right to receive a potential inheritance, the right to receive a personal injury lawsuit, anything. You have to disclose all of that. So it's a really good financial snapshot for the IRS to use in analyzing whether or not the offer that you're making is the best offer the debtor can put forward or the taxpayer can put forward. So getting that IRS tax lien released was huge for our client. About a year after the bankruptcy, our client was able to apply to purchase a home using an FHA loan. People think bankruptcy is, the end all for 10 years. You're not going to get new credit. You're not going to do anything. that couldn't be farther from the truth, especially nowadays. We live in a plastic society. The only way credit card companies and banks make money is if you're borrowing. So they've loosened those standards tremendously. You can buy a house in a Chapter 13 bankruptcy, provided you've got the 3.5% down, you've got court permission, and you qualify for that FHA loan. The FHA, the underwriters will use the Chapter 13 repayment plan as your new credit. So as long as you've made 12 timely payments in your Chapter 13 plan, you have not incurred any new debt, you're not going to have a problem reestablishing credit. The one thing that you can't discharge in bankruptcy is student loans. That is under 523A8 of the Bankruptcy Code, unless there is a hardship. And that hardship threshold has been set very, very high. It's been problematic. We have received bipartisan support in probably the shortest piece of legislation I have ever read in my 25 years. What they did was they took 523A8 and they removed the word not dischargeable. And you'd be surprised at who signed onto this bill, about 30 Republicans and Democrats. I think the bill was sponsored by Dick Durbin and Josh Hawley, two opposite ends of the spectrum. It's been sitting in Congress because Congress is, we know, dysfunctional right now, but it had prompted the Biden administration to create a new policy change dealing with student loans. Super helpful. It had a huge success rate. We're not sure what's going to happen with that student loan program right now. But again, bankruptcy is the place to handle those student loans, that student loan issue, because it offers guardrails. It doesn't mean anyone who owes a student loan can walk into bankruptcy and get a discharge. We don't want, the doctor or the lawyer who's, making, $1 million a year to just be able to discharge their student loans when they have the ability to pay. That's not what we're talking about. We are talking about people who have suffered hardships, who never made it, in their career for whatever reason. Most of the things that we see are health issues. So kind of off subject, but just giving you an idea of the tools that we do have in bankruptcy, and it's a creative area of law and the things that we can do on tax discharge. One of the things that when I'm teaching this to the USD tax clinic, I come in and do one class a semester. Professor Carpenter, by the way, is phenomenal part of USD's tax program. But one of the things that I also talk about when we are representing clients in really anything, but under the tax and bankruptcy umbrella, is put things in writing. If your client has to make a decision, you've given them the tools, you've advised them, but the decision falls on them. Whether or not they want to move forward with the bankruptcy now to stop a foreclosure, maybe they have a foreclosure sale date, but if they file now, they won't be able to discharge some tax debt because that tax debt is not eligible to be discharged until October. This is an actual case I had. So I do what I call a memorandum of understanding, an MOU, where I lay out the client's options and I ask them to select which option they choose, and then they sign and date that. And I've got a record in my file that they made an informed decision. This case, the clients loved us, gave us great reviews online. We're very grateful that we saved their house. And then about a year later, I get a letter from a lawyer, malpractice attorney, that said, hey, please send me your claim information, your malpractice insurance information. My client has a claim. You should have waited until October to file their bankruptcy to be able to discharge this 40 grand in tax debt that they had. And I said, nope, here's a copy of my MOU and why we did that. And the client made an informed decision on that. And the malpractice attorney wrote me right back and he's like, I apologize. I should have asked you what your position was on this first before asking you for your malpractice insurance. You're one of the first attorneys I've ever seen have that. So I commend you on that. And I thought it only took, maybe 30 minutes for me to write that up, keep it on file, and I had it. And the client even apologized, but you got to remember, it doesn't matter how great the service that you may have gotten was. If you're the deep pocket that might save them paying 40 grand, they're coming for you. So as lawyers, we've got to be very, very careful that we are documenting our files, we are properly informing our clients, things like that. That's kind of my overall presentation. I know we've got about 20 minutes. I'm happy to answer questions.
Thank you so much, Jenny. That was super interesting, especially for someone that does not know a lot about tax law. I really enjoyed learning about that. I wanted to start off with a question because I know we had a few people join late. What just really interests me to hear again, especially after hearing so much more about the subject, is how your LLM and taxation really played into your career in the tax field.
Yeah, so I was so excited going. Number one, I love law school. I told my friends when I was in law school, I would love to go to law school again. I don't want the tests and I don't want the bar exams again, but I really love the learning experience. I am an information person. I love CLE. I love speaking at conferences and going to conferences. So I knew I would love the learning side of it, but what it did was it gave me the tools that I needed to grow my tax practice, to grow that side of practice, to be able to use it in my bankruptcy practice, to be able to use it nationwide with colleagues. I mean, the networking I've done using my LLM nationwide has been incredible. Being able to reach out to colleagues. I've referred several colleagues to the USD program, and I think it's even more feasible now that there's also an online option. So for me, it's grown my practice tremendously. I will say when I was pulling my numbers, I'm not done with my taxes yet. Yes, the tax attorneys always last, right? The plumber's faucet leaks, same in our world as well. I'll probably need an extension. But just pulling my financials for 2024, my growth in the tax practice went up 30% from 23 to 24. And I am already this year, I see most of my clients back to back on a Wednesday and a half day on Thursday, because I need the other days to actually have uninterrupted work time. That's just what works best for me. Our tax clients, we were running about a 30 to 70% bankruptcy caseload, 30% tax caseload. Last year, we hit 40% on the tax side. This year, I am almost 50-50, and it's only March. So the level, how we've leveled up on our tax practice has been phenomenal. I have done a little bit of marketing for the tax stuff, not a whole lot. I'm not spending a ton of money doing it. I include it in my logo here so people can see. When I'm on hearings and things like that, they're like, oh, Jenny does tax, things like that. I don't do tax prep. I should be cautious when I say that. I do tax controversy work and tax discharge work. So watching the practice grow that much just since I got my LLM has been huge. And part of that is because now I have the confidence and the knowledge and the contacts and the networking support system behind that to actually grow my practice. So that investment has paid off already.
Awesome, thank you.
Yeah.
We had another question in the chat. I heard rumors that student loans are normally not dischargeable in BK proceedings. Would you say that is generally still the case?
Yes, that is generally the general rule. 523A8 of the Bankruptcy Code says they're not dischargeable. So there has to be a pretty extensive hardship that you have to show. In the past, I had 100% discharge rate on student loans. You had to do it through an adversary proceeding. An adversary proceeding is basically a lawsuit within the main bankruptcy case. It has its own case number. You have to serve a summons and complaint, the whole 9 yards. You go through discovery, you go to trial, all of that. I had 100% success rate, but that's because I only took cases that I knew I could get through, because that threshold was so high and hard to meet. Then the policy change that I mentioned, and lawyers don't like policy changes. We want to see a statutory change. I want to see case law. I want to see something that I can look at definitively and say, hey, we can fit you in one of these boxes. But this policy change basically said, if you meet our criteria, the DOJ, which has the United States Attorney's Office, the U.S. Attorney's Office represents other branches of government when they're sued. We essentially sue the Department of Education. The DOJ appoints representation for that, and then you negotiate with them. So they said, if you meet this criteria, then we're not going to oppose the discharge. We will stipulate to it. And that's fine. That's not a problem. We're not having to go to trial and have a judge make a decision. And in bankruptcy, there's not juries. It's bench trials. So things go a lot quicker in bankruptcy. We are not sure that program, the numbers after 1 year from November of 22 to November of 23 showed that of the files that were filed and processed, 90% of them received some relief, and over 50% received 100% relief. So that showed what a great need, and we were wasting, the federal government was wasting a ton of money attempting to collect non-collectible student loan debt. So clearing that off the books was kind of a win-win for both sides. We don't know, we have a new administration we're dealing with, so we don't know if that's going to be around. We also don't know who we're supposed to sue now, because if the DOE is gone and now apparently the SBA is going to be handling student loans, we may be suing the SBA. I don't know. We're kind of in this unknown, uncharted territory right now.
Awesome. Thank you. That is it for questions in the chat. Do we have any other questions if someone would like to unmute themselves and ask? Otherwise, I will go ahead and take over. Thank you so much, Jenny, for your time and expertise. That was super interesting.
Thanks for having me.
As a closing argument, if you will, I would like to share our quick overview here of our new program. I hope everyone can see the information here. We have our new online LLM in taxation now offered in evening, synchronous and asynchronous courses. So it works a lot better for professionals that don't have the time to take off to get our wonderful LLM degree here. So we now have it designed for evening classes beginning 5 p.m. San Diego time. Designed for working professionals, keeping that in mind with course load and everything. And I will drop my calendar link in the chat here in a second. And anyone that is interested in learning more can either email me or sign up on my calendar, and I'd be happy to discuss our new program online or in person, our top 10 ranked LLM program nationwide. We would love to see you there. Thank you again, Jenny, so much for your time.